Okay, good afternoon, everybody. This is Dennis Wilburn. Welcome to On the Radar, our live updates that we do just after the market closes now on Tuesday, Wednesday, and Thursday, though. So that's at 1 o'clock p.m. Pacific time every Tuesday, Wednesday, and Thursday. And so let's get into today's session. Today is the 28th of January. It is also the 18th trading day of the new year, 2021. Well, it's not, basically in this session, I'm going to be covering three things, basically. I'm going to be covering the indexes. I'm going to be covering a couple of potential short trades that you may want to take a look at. And I'm also going to be chat briefly about the crazy price actions that have been taking place on Gamestop, GME, and AMC. I have to tell you, I don't know if you've been following this or not. If you're a trader, you have been following it. The volatility and the movements there, to be honest with you, I haven't seen anything that volatile since back in 1999, 1998, 2000, right before the bubble burst, the dot-com bubble burst. And what they were saying there was this time it's going to be different. I haven't really heard anybody say that specifically, but there's been several people that have done very well in this move of GameStop and AMC. And we'll get into a little bit of the science behind what they in fact have been doing. But before we do that, stay to the end because we're going to be touching that because there may be some trades you want to look at on those two stocks because guess what? Nothing can, for every action, and there's an equal and opposite reaction. Well, stand by. That if that is the case, that means we may get some downside on GameStop and AMC. So hang on. So let's jump into the spider representing the S&P. What's going on here, as you will see, price actions this morning basically opened down here, midsection of yesterday's large bearish gap down, large ring candle where it came down, touched off the 34, and then this morning rebounds. Gaps up from yesterday's close, and then runs up just in between. And this is something really, spectacular to look at because it is very much what you would expect. We had a gap down yesterday. Now, here's your tech tip for today. When you have a window gap or a gap down or a gap up, the midsection of the gap tends to be very predictive and very strong levels of either support or resistance. Since it was a down gap, a falling window, the midsection is a level of resistance. And price actions worked its way almost with the same range as yesterday, worked its way up into that mid gap, stopped almost on a dime, reversed, and the sellers came in the rest of the day. Right now, if you take a look at what's going on from a futures perspective, the S&P, the spiders, they are painting right now 375.60 to 375.72. So they're down right back at, basically at today's lows. We take out today's lows. We take out this and close below this uptrending channel and the 34-day moving average. Increases the probability we're going to drop all the way down to the 50. And maybe even further than that. With that said, what I'll be looking at trading, of course, I prefer trading either the NASDAQ, the Qs, or Russell, IWM. I think that all three actually put in good patterns, but I don't have to trade all three of them. Typically, for a tech stock, I like trading those. NASDAQ is where I want to basically be looking for my swing trades. And that's trading both the Qs and the leveraged ETFs. If you don't know how to trade the leveraged ETFs, you're going to be really wanting to stay tuned to active trend trading. We're launching a leveraged ETF service moving into next week with a big launch happening around the 5th of February. It's going to be really hot. If you've been following the top 5 autopilot trading system, this is going to be the leverage ETF autopilot trading system. And last year, basically, it's going to provide you the triggers. It's going to provide you where to get in and out. If you're tired of looking for stocks to trade, the ETFs. I wish when I started trading 30 years ago, we would have had ETFs. There's so many benefits in trading the ETFs, plus the upside benefit of compounding yearly for over 100%. And if that's something that might interest you, you're going to want to come in and tune back in next week, where we'll be getting more in depth into the autopilot leverage ETFs. So let's jump down to what's the next on our list is the Qs. Similar type situation as with the we had as the S&P, except basically what happened today was price action opened with a slight gap up from yesterday's close, gap up, run up really hard all the way up into yesterday. The high from the day before was 326.27. The high for today was what? 326.42. So within just a spitting distance away from yesterday's high. Then the sell-off started. Pow, running all the way down. After hours, what's going on? The Qs are down over $2 after hours. If I look on the, I also want to take a look at what's going on in the futures. Now, the futures can run around after hours. They can go up, they can go down. But remember with the futures, don't try to necessarily plan your trading day tomorrow based on the futures at, it is now 6:30 in the evening Pacific, because there's got a lot going to happen between, in the next 12 hours. The Asian market comes online, the European market comes online, and news can come online here in the U.S. to basically just reverse the futures, the fortunes of the futures overnight. So at the same time, though, we are seeing some weakness. Close below the 20. Possible to move all the way down to the 34 at the 314 level. Next down after that is the 309 level. How will I be looking to trade this? I'll be looking at, I like the move back up into the 8-day moving average. If that happens, I will basically look to potentially trade that to the downside. Can afford to wait. If we're going into a more significant correction, I know that we're going to be testing either the 8 or the 20 after it breaks below it. That's where I'll plan my, do my plan of attack to get into a downside trade, and I'll be either buying puts or I'll be doing a put debit spread to take advantage of things going down. Since the NASDAQ and since the Qs have weekly options, I usually will, if I'm doing a short-term swing trade, I'll go out about 2 weeks. And so since tomorrow's Friday, the 29th, I'll be looking at probably going out to the 12th. Depending on how strong the trend looks, I may go to the 5th of February, but certainly the 12th of February would give us a couple of weeks for the trade to come in for us. And so that's the way I work the option trades on that. Coming up next, IWM. IWM gave us some nice moves to the downside this week. Now, oftentimes, just keep this in mind, oftentimes the Russell leads. The Russell leads both up and the Russell leads down. What do we have going on here? We basically have a test of the the 8 today, a test of the 20. We're in this area, and I call this the jackhammer effect. Now, the jackhammer effect is very simply let me get my pencil up here, is basically a time where price action will come down and hit the moving average. Pow. Hit. Until eventually it jackhammers it like a piece of steel to bend or to roll over. And the same thing we're getting here on the 20 now. Hit, hit. And eventually what we will see, of course, is these moving averages starting to roll over and get ready to drop down. So as soon as we do get that rolling over, and the price action that takes place while you're doing that is oftentimes you get this ping pong effect between the lower, or well, in this case, the higher moving average and the higher moving average up here, the 8-day and the 20, and just get this ping pong effect where it just ping pongs between the two of them until finally it does a breakdown below it, and it'll continue to move on down, and we'll see where it goes from there. Now, where might it go? This is where I want to throw on a Fibonacci real quick to give us an idea of if this is merely a pullback. Go ahead and grab that. If this is merely just a pullback, what I'll be looking at, guys, is probably somewhere into the magic fib box. And the magic fib box is marked by the 382 and the 618 fib retracement. Where does that put us? And I also want to be looking at, in those ranges, do I have levels of past support / or resistance? And sure enough, at the 50, I have some support down here about 204, almost 205. You can see that today's candlestick, yesterday's candlestick, basically have found support at both when they coincide and you get a double up of the clues, the 38 and the 20-day in this case. That's an indication that, okay, that is a strong level of support. That's where we could potentially plan trades off of. However, we are getting the momentum swinging down, and we'll see where it goes from here. You basically come on down, test at 204, come down close to the 34, which is another level of support. Look to your left, right here, this high at 201.18, and the Fibonacci is where? At 201.24. That's the lower part of the magic fib box. If we get down to there, that oftentimes will lead to a really good place to spring load a new trade to the upside. That's where we'll be paying attention. Does it happen every time? No, but it happens enough, often enough that we want to be paying attention to the fibs. If we get all the way down to 618 and it fails, look at this. Gap down area back all the way to the 50-day moving average. So the retracement could, in fact, be all the way down to approximately the 50 at the 786 Fibonacci retracement. So that's the way I'd be looking at trading IWM. Any kind of a move back up into approximately from 209.75 all the way up to 212.35, or probably right at the 8-day moving average, 211. 211 might give it, that would be a opportunity to take a trade off of that action value zone, and that's a action value zone of resistance. So I'd be looking to trade that to the downside. Stop loss just slightly above yesterday's high, which is up at 212.99. So let's get into with that said, a couple of stocks that are of interest to us. One, Facebook. Facebook, Twitter, a lot of these social media companies, they are in fact taking some heat. Why are they taking heat? Well, one of the reasons they're taking heat is the American population, the American citizens do not like to be censored. And these SOBs, I'm just going to call it the way it is. These SOBs are censoring free speech, and be careful what you sow, because you're going to reap. And so basically look for Facebook, look for Twitter, look for some of these big tech companies to get their faces ripped off, and we'll see what's happening, because something unique is happening in the market right now. I won't say that things are that it's different this time, but there's something new at play, and we'll get to that in just a moment with GameStop and AMC. Here's what I'm looking at. Facebook. Facebook has rolled over, and earnings are out of the way. It's looking like it has a pretty clear path all the way down here to the 252 level. So any type of a retracement back up into the 271 level, 270, 274, correction, 270 and 24 cents, which is the 50-day moving average, all the way up to 272 maybe. That would give us a good place to throw in a, bearish option trade, which would be either a selling a call credit spread or buying a put debit spread. And I would make it slightly out or slightly in the money. In other words, if it was a call, I would be looking at, if I get up to 270, I could say, hey, I will sell the 265. And I will buy and sell the 265 call, buy the 270 call, and just let that trickle on down here to 254, because that's about $10 away. Or another way of trading that is you could basically take and say, I'm going to sell in this case, I think they have 262.50 options. Let me take a real quick peek here. And hold on just a sec. Yeah, they have their options are $2.50. So you could actually go $2.50 wide options, spread. And so what I could do is go down here down to, let's say 262.50 and sell that one, buy the 265, or go a little bit deeper if you want to risk a little bit more. What that does for you actually is you'll be able to take enough credit in where you'd probably pull in probably on a $5 wide spread that was selling the, let's say the 260. You'd probably be able to pull in somewhere about $3.50 or so. And so there your managed risk would be about $1.50 per contract. And you could do the similar type thing to size it up properly with a put debit spread, where you could buy it for $1.50. There's your max risk, and you'd have an upside of $3.50 on that particular spread. Now, of course, when I plan my spreads out like that, if they're 2 weeks long, I try to close out that spread as soon as it starts closing out pieces of it, when it hits 40% of max profit and then 60 to 80% of max profit. I do not like to hold my spreads all the way through expiration, because too many things can happen in a short time frame with this volatile market, and especially working with these high-powered growth stocks. The other one I took a look at, Netflix, same type of situation. Excuse me. Of course, it helps if you put in the ticker the right way. There we go. Netflix. As you see, Netflix came up and retested today and then sold off. We could do a couple of things. We could say, hey, if it drops the 533 level, let's turn around and sell the today's range was approximately, what was today's range? $22. And so what we could do is, let me get this more in, any type of a track up in between the 8 and the 20, there's the ping pong effect. If we take out today's high or yesterday's high, we'd want to be out of a particular spread, a bearish spread on Netflix. And when I say take it out, I'd probably be looking at yesterday's high was what? 556.42. So if it ran up above 557.75 or 80, I would want to be out of the trade, because that means we were breaking out and it was changing its personality. So if I did something at about, let's call it 242 to around 242 to 240 level, so where that would be my trigger to get into a trade, and just write it all the way down here to approximately this uptrending line, which is at the $505 mark. And so that's where I would want to be doing it. I will take a look over at the weekly chart just really quick. And tomorrow is the last day of the week. We had a big, with earnings, a big move up on Netflix. However, whenever you have a big move up on earnings, but it gets into an old level of resistance and then fails, and so you basically have a breakout fake out, oftentimes that can mean you're going to retrace back down to the lower levels there. And with these larger, size stocks, it's had like in this one, it's had a range for the week of $54 for just this week. And so within that $54, similar to what these guys are doing with Gamestop and AMC, they're basically just placing bets, if you will, that price action is going to move with great volatility through that area, therefore increasing and giving their profitable trades. So that's what I'm looking at with Netflix and Facebook. You may want to throw Twitter on there also, because it is also starting to roll over. And those were stocks I would look to trade to the downside. So now let's take a real quick look as we close off today. Let's take a look at these crazy stocks. One of them is AMC. One of them is GameStop. And what's taken place. And here's the gamut behind this. I left the volume on down here. And the social media, and it's oh gosh, what is the name of it? It is not Robinhood. Let me see if I can call this up. Anyway, it's a social media group that basically started calling out and started doing some investigation and taking a look at these stocks that belong to the S&P 500, and started sending out text messages and messaging and all that type of stuff, and all of a sudden their members started doing what? They started buying the stock, which in turn resulted in what's called a short squeeze, because many, and in this particular case, the people that they were squeezing was the institutions. The institutions which were short because they weren't expecting AMC or GameStop stop to be moving up and do anything. And so when you get a short squeeze, what happens if you're short the stock and prices start moving up, it hits where you sold that stock at. Remember, you don't own the stock. The institutions did not own the stock. And prices kept rising. All of a sudden, at some point, they have to cover their losses. In other words, they hit their stop losses. They then start the avalanche of additional buying of millions and millions and millions and millions of shares, so that the turkeys that got in down here, down here, when this movement, this tsunami first started, they then were swept up in the tide, and a lot of them jumped out up here, and then it followed. Now, much of this is again a news-driven event, so nothing has really changed about AMC, folks. So how would I particularly want, is it still time to take advantage of this trade? Well, we can speculate, and I'm looking at a speculative trade here, is any type of, basically price action has come down almost all the way, this is a weekly chart now, almost all the way back down to this level here, about the 779 level. But it ran, you have to remember, in just a couple of weeks, this stock has run how much? From low to high, okay, almost 965% in 4 weeks. $18.45 would be the total run. So that's pretty impressive. Now, how would I want to potentially be trading this right this moment in time? Is I'm going to be watching this on a daily chart, and where I'd be looking at doing a speculative trade, probably looking at about a month, 2 months, 3 months. with the anticipation that this is going to fall back down towards these past levels here. How far? I don't know. But if this phenomena of hitting these highs over here was basically just a news-driven event that was done by, the strategy was brilliant. The strategy was really brilliant in that, get a bunch of retail investments together with communicating with each other via social media to say, we're going to start buying some AMC. And then it just started creep, and all of a sudden it started hitting squeezing the shorts, and then all of a sudden it took off like a rocket ship. So what I'd be looking at doing is probably taking it about, if I get down or get back up to about $10, I could turn around and I could basically do one or two things. I could buy a $10 put and sell, let's say, a $7 or $5 or $7 put, or whatever would go in there, and then just ride that back down. Now, is it going to give me the same type of explosive, move of thousands and thousands of percentage points? No, it is not. However, it does give you an opportunity to play in what's been going on with these. As you're aware, probably, that many of the brokerage companies, including Robinhood, has come out and restricted the buying and selling, or the selling especially of buying and selling of both GameStop and AMC. However, the options are quite active. At the same time, while the options are quite active, they are also very volatile, with the implied volatility being pretty huge. Here's looking out to just 2 weeks. The implied volatility on GameStop is 657%. Guys, I have not seen that kind of implied volatility going back until the dot-com bubble era. So, however, if you trade the spread, you take off, you basically are able to eliminate a bunch of that particular, of the implied volatility. Because this is, what is this? This is a, this stock is, what's the stock doing? I think it's, hold on a second, let me give you a picture of this. It's $300. So if I go down here and at the money call on this right now, that's 2 weeks out, 159 contracts of open interest. It's gone from $52 to $102. That is a huge split. If I go out just 1 week and go to and at the money, it's still looking at somewhere between 50 and 100. That is, that is basically, you're going to be able to, try to get in on that. It's going to be questionable. Now, what happens if you went deeper in the money? If you went down and grabbed a, as you can see, it's still showing huge differentials here. Here's one, the 350 call, which is down, yeah, because that's way above it. But the 350 put, look at that. I mean, it's a $100 wide bid ask. And so, again, I'm not going to be buying the individual directional calls or puts on this. However, if, I was to look at trading this, let's look at this. I'd be looking at a pullback into the midsection there, about the 220 level, and then I could either do, one or two things. I mean, I could do them both. I would, I could do both a bullish and a bearish trade, but I think predominantly the bearish would be more indicative. And you have to look, today's range is, this is insane. The range on GameStop today was, I gotta move my, I have to move something out of the way here. Hold on a second.